Here are the STC crunch time facts for the Series 65, Chapter 12. A bond is a debt instrument for which investors agree to lend the issuer money, often in exchange for the payment of interest until a specific date in the future. Issuers of bonds include corporations, municipalities, and the U.S. government. A bond's par value, also referred to as the principal or face value, is typically $1,000. Bonds may be priced above par at a premium because, it's a luxury, it's above the normal price, or below par at a discount. I'm getting a good deal. Bonds are typically sold with a markup rather than a commission. So when they're sold, they're usually sold at a little higher than market price rather than charging like a sales fee or a little extra commission. A bond's maturity date is the date on which the investor will receive her principal back plus the last interest payment. So once someone's grown up, they're said to be mature. So once the bonds kind of come to an end, it's said to be its maturity date. The coupon rate, also referred to as the nominal yield or interest rate, is the fixed percentage of the par value. So basically, just the interest rate, what it's paying you in terms of what you're not making back at the maturity date. Bond prices have an inverse relationship to interest rates. When interest rates rise, outstanding bond prices will fall. This is because if you have a bond that pays 5%, has a 5% interest rate, and a new bond is issued that pays 7% interest rate, yours is going to drop in value because it pays less. Long-term bonds have more interest rate risk than short-term bonds. Duration measures a bond's interest rate risk, or how sensitive it is to interest rates. Bonds with larger durations have more price volatility. Zero coupon bonds pay all interest at maturity. A bond's nominal yield, or coupon rate, is the annual interest payment divided by the bond's par value. So that was a formula. So a $70 annual interest divided by a $1,000 par value would be a 7% nominal yield. Current yield is annual interest divided by current market price. So that's like your current return. Yield to maturity is the return on a bond's investment based on the bond being held to maturity. So the yield at maturity. For a discount bond, the highest yield is its yield to maturity, followed by its current yield, and lastly, the nominal yield. For a premium bond, the highest yield is its nominal yield, so yield in name, followed by its current yield, what you might actually be getting, and lastly, the yield to maturity, if you hold it all the way. Conversion price multiplied by the conversion ratio equals par, so $1,000. An example would be if a bond is convertible at $25, the holder is entitled to 40 shares, so 25 times 40 is 1,000. Bond investors can be exposed to interest rate risk, reinvestment risk, inflation risk, and credit risk. U.S. government debt securities include Treasury bills, Treasury notes, Treasury bonds, Treasury strips, and Treasury tips. Mortgage-backed securities are secured by various types of mortgages. That may have been the most obvious fact that we've seen so far. But hey, that's great, we'll take an easy one. The Government National Mortgage Association, GNMA, or some people say Jeannie Mae, is the only mortgage-backed agency security that's directly backed by the U.S. government. Municipal bond interest is tax-exempt at the federal level, but may be subject to state and local income taxes. The two main types of municipal bonds are general obligation and revenue bonds. General obligation bonds are backed by the issuer's taxing power, while revenue bonds are repaid from money earned through specific projects. Bonds that are issued by foreign governments are referred to as sovereign bonds. Bonds that are issued by foreign governments and foreign corporations typically pay interest and principal in a foreign currency. Money market securities are debt instruments with 1 year or less to maturity. And our last one, structured products are debt instruments which offer a rate of return that is linked to an underlying security or basket of securities. Hope this helped.